Borrowing capital to grow a startup has distinct advantages, but it can cost more than you expect.
This week on Bootstrapped, the lighter side, Tanner Kovacevich, Lighter Capital's VP of Sales, and Patrick Philley, Lighter's lead underwriter, discuss the hidden costs and hidden risks that catch founders by surprise when taking on debt. Learn how to navigate the intricacies and potential pitfalls of funding your startup with debt from two seasoned experts helping entrepreneurs secure growth capital for nearly a decade. Welcome to Bootstrapped, the lighter side, the podcast for B2B startup founders wanting to achieve success without giving up ownership or control. This podcast is brought to you by Lighter Capital, the leader in founder-friendly financing for B2B SaaS companies. Learn more at lightercapital.com. Well, I'd like to start off with just brief intros from Tanner and Patrick. Tanner, why don't we start with you? Can you tell us a little bit about you and what you do at Lighter?
Yeah. So I've been with Lighter Capital for over 6 years now. Currently, I manage the sales team and am still active in deal flow. So to date, I've done over 80 transactions and deployed over $40 million in capital. So seen a lot when it comes to various truths in lending and how other capital providers position their offerings. So, excited to expand on that a little bit with the team here.
All right. Thanks, Tanner. And how about you, Patrick?
Yeah, so I'm a manager credit underwriting at Lighter. I've been here for over 8 years now, and I think I've done over 200 transactions here, maybe close to 300 throughout the
Wow.
years. So yeah, I've seen a lot of different offers that our borrowers and clients have taken from other lenders, lots of different structures out in the market. I work on the underwriting side, so looking at the credit of the potential borrowers and analyzing the financials.
All right, thanks. So for people who don't know how lending companies work, there's typically a lot of tension and healthy tension between Tanner's side and Patrick's side. Tanner's trying to get as many deals as he can done, and Patrick is trying to make sure that we are managing for risk. But I will say, you guys, having worked with both of you for over 4 years now, really navigate that beautifully. So I am Melissa Widner. I am the CEO of Lighter Capital. I have a long background in the startup arena. I was a startup founder myself. I ran two companies that had successful exits. And then I spent close to 2 decades in venture capital, most recently running the venture capital arm for a large bank in Australia, National Australia Bank, where we invested primarily in fintechs, including into Lighter Capital. So now that I am at a company that provides non-dilutive funding versus dilutive funding, I get asked all the time about the difference between venture capital and revenue-based financing, what Lighter Capital does. And when should companies take debt and when should they take equity? And my answer is when it's an equal size opportunity, meaning say you're looking for $1 million and you're able to take $1 million from both debt and equity, you should always take it in debt. And I'll explain why. And unless, with a couple caveats, and one is if the equity is going to bring you so much value, if that relationship through equity is going to bring you so much value that it will increase the value of your startup by enough to justify how much of the equity you're giving away, which can be anywhere up to 30 or 40% in the early days of a company. So there's got to be a lot of value that equity is bringing. And then the second reason you would take equity over debt is if the debt terms are really going to put the company at risk, if they will be hard to service, then debt might not be an option. Typically, when companies do opt to take equity over debt, it's because they need a lot more cash than they could access using debt. So at Lighter Capital, we are able to fund for larger companies, up to half of their annual revenue with debt. So if you look at a company doing, say, $3 million in revenue, we could fund, if they qualify, up to $1.5 million. So if that company doing 3 million in revenue wants to raise $10 million, they can't get there with debt. They might be able to partially get there with debt, but they're going to have to go down the equity route. So oftentimes that's why companies choose equity over debt, and oftentimes they combine the two, even in the same financing round. So with that, we are going to get into a topic that is near and dear to my heart. I know to Tanner and Patrick as well. And that is how to help founders spot the hidden costs and some of the deceptive terms you could see from lenders that make it really difficult to understand the true cost of borrowing. I think at Lighter Capital, we pride ourselves on being very upfront on the APR. And a lot of times we are competing against term sheets where they're not. And unless you have a background in finance, it can be really difficult to understand what the true costs are. So we want to get into that with the goal of helping founders understand these types of term sheets better. So why don't we start with you, Tanner? What are some of the hidden fees that you've seen in other term sheets?
I think in addition to not exactly portraying what the APR is, there can be a lot of fees to a loan. It can be what the total cost of the capital is in regards to like a repayment cap. A really easy example of that is lender gives you $100,000 and they charge you, say, $115,000 over 12 months. That's an example of not an APR, but more of a fee structure on a loan.
Okay, can I just back up on that? So
Yeah.
they provide you with 100,000 in capital, and you are going to have to pay back 115,000.
Mm-hmm.
Okay.
Yeah. And that can be kind of in equal payments over 12 months or something like that. And I think additionally, outside of like a cost of capital, there can be legal fees, there can be origination fees, and there can also be exit fees. Legal fees, can vary from lender to lender. It's definitely important to get an understanding of why their legal fees are at some kind of set standard. It definitely can vary widely. So that's something when you're comparing term sheets, it's an important factor that can increase the total cost of capital. Origination fees are fairly standard in the market, and it's essentially the cost of people like Patrick, doing the loan and underwriting the loan, executing loan documents and things like that. So that's a cost, and it's usually viewed as a percentage of the funded amount. And exit fees. So this is something after the loan completely amortizes, there can be some type of additional payment at the end of the loan. So this is a way for a lender to potentially have less cost of capital up front, but then on the back end, they can charge you more. So that can definitely increase the total kind of cost of capital when you're looking at something and comparing different offers.
All right. So let's dig into how fees can be disguised as APRs and what a discount rate means. I think this is one of the most common things that we see. So Patrick, I will ask you this question. If I'm a founder and I'm looking to borrow $100,000 and I get a term sheet that says you're going to pay me back $115,000 over a year, I would think that's a 15% rate. Is that correct?
Yeah, I would think if I didn't have my background, I would think the same thing. And if you didn't have to pay, if you got $100,000 and you didn't have to pay that 115,000 back at all until 12 months from now, it would actually be a 15% APR. But we almost never see that. Almost always you're paying that back monthly or
And
sometimes even
sometimes weekly or daily.
that's right. And that ends up making the loan more expensive because you're amortizing that loan every month, but still paying that $15,000 of interest over that 12 months. And so let's say in that example, you borrowed $100,000 and you pay back 115,000 over a year. You pay it back equally over a year. That payment would be about 9,600 a month. That actually ends up being a 27% IRR.
Wow.
Where
It's a little different than 15.
exactly. If you got a term loan that was, actually had an interest rate of 15% and kind of looked like, your mortgage, you would actually only pay back $108,000 over that 12 months, and your payment would be more like 9,000 every month. So it kind of goes to show that that repayment cap or that total fee, or sometimes it's called a discount rate or an annualized fee, it is not always equivalent, and often is not equivalent to an APR or an interest rate. And then sometimes this is a pretty simple structure. In this example, there are also other fees that lenders will have, such as a drawdown fee or legal fees, or they tend to frame it in even more confusing ways. So it's always important to press your lender on the actual annual interest rate, because that is kind of like the most common way to and most way to compare a loan and the cost, the borrowing cost, the cost of capital, apples to apples. That's what most people are familiar with.
Yeah, and I would say get it in writing, right? When you get an offer, say, I
Right.
want to know what the APR is and make sure that you have that in writing. It is the easiest way to compare apples to apples. Okay, so we gave an example of a 1-year loan and where something that could look like 15% is actually 27%. We've seen rates even much higher than this for short-term loans. Patrick, do you want to talk about what we sometimes see in the MCA space?
Yeah, totally. So sometimes in the MCA space, and typically companies might turn to these because there can be a quick turnaround, or you just might be really, really needing in a cash crunch, really needing a quick burst of capital. These type of loans, you might get, let's say, like a $100,000 loan, and what looks like not a huge fee. Like in this example, let's say $100,000 loan, and you only have to pay back 6,000 in fees or total interest. But what really matters is how fast you're paying that back in terms of APR, because if you're paying back in that example $6,000 in interest on a 100K loan, and you're paying that back over, let's say, 3 months, that ends up being a 36% APR or IRR, because you're paying that interest over such a short amount of time. And sometimes these MCA loans can be paid back. In that example, that was only paid back monthly. Sometimes you're paying it back weekly or even daily, and that just adds to your APR IRR because it's compounding and you're paying it back quicker. You're getting less access to the capital. And so it's just always important, again, to understand what the APR is, what the interest is, but also relative to how quickly you're paying it back.
I think what's important too is when you take out any type of debt facility, whether it's 3, 12, or 3 years, it's important to be confident that you're going to get a return on that investment. If it's a 6% fee, as Patrick said, in 3 months, for most early stage businesses, that's really hard to get a return on the investment in that short amount of time. Whether that's hiring a salesperson or starting a new marketing campaign or something else to fuel growth. Typically, if it's just an emergency cash flow issue, those 3-month loans can be a good solution. But typically, it takes businesses longer to actually get that return on whatever the cost or fees are of any given loan.
That's a good point. What other closing advice would you have for entrepreneurs who are considering taking debt?
Yeah, I would say ask your lender to always clearly identify all of the fees and finance charges of a loan. Any fee or any additional dollar that relates to you borrowing or taking on that loan should be included in your cost of capital and your APR. And that gets to my next point. You should just plain and straight up ask your lender what the actual or effective APR is of their loan. If they have a kind of confusing way of framing what their fees are or what their rates are, and it isn't clear if it's an APR and an interest rate, you should just ask them how does this translate or convert into an APR and an interest rate? I want to be able to compare it to other offers, or apples to apples with something I'm used to, like an interest rate.
And ask them if all fees are included in that APR calculation, because the fees can
Right.
really change the APR dramatically.
Exactly.
Okay, what other closing advice do we have?
Yeah, I'd say also it's important to understand when you're going to engage in a relationship with a capital provider, what they provide outside of capital. Whether this is going to be a simple transaction for the capital provider in the business, or do they provide other things like a network, introductions to venture capital firms? Is it possible to connect with their other portfolio companies so you can maybe cross-sell or partner or things like that? And is there a sense of the community within the portfolio of the lender that you're working with? Not all lenders do that on a regular basis, but it is, a value add, outside of what we're talking about with cost and fees and things like that. And it could really help you, grow the business long term, if they do have those things outside of just capital.
Choosing the right financing partner. And I think what I'm hearing you say, Tanner, is it's not necessarily strictly cost. You want to really understand what the actual costs are, but look at the other benefits you're getting, and if there are benefits that can help you grow your business.
Yeah, I mean, absolutely. A capital provider can be a long-term relationship. So, in addition to the community they have, you want to know and understand and like the person that you're working with, for a long term, which definitely brings me to my next point. And I think the final thing I'd recommend to everyone seeking capital is ask the capital provider to talk to some of their portfolio companies. If it could be a red flag if they say, absolutely not, maybe there's another circumstance as to why they wouldn't let you. But to get the real life example for someone that's in a similar position as you, one of their portfolio companies, and get an understanding of how they do servicing, what happens if you get behind on payments and things like that. You really want to understand, what their experience was like, because it could be the same for you.
Thank you, Tanner Kovacevich, Head of Sales for Lighter Capital, and Patrick Philley, Lead Underwriter.
Thank you, Melissa.
Yeah, thanks for having us.
We hope you enjoyed this episode of Bootstrapped, the lighter side. To receive future episodes, subscribe using your favorite podcast platform. And if you enjoy this show, please share it with other fellow founders and entrepreneurs. For more insights, helpful tips, and to learn more about founder-friendly financing options, visit us at lightercapital.com. That's LIGHTERCAPITAL.com.